evening seminar on export import, risk and frauds in export import, which is handled by, which is going to be handled by CA Raghavendar. Before starting the meeting, I request all of you to stand up for the ICA notice.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनाद्यैकश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you, members. Now I request our branch chairman to formally welcome the guest.
Thank you, Mahesh. Good evening, members. On behalf of Management Committee of Tirupur branch of SARC of ICI, I welcome our today's speaker, CA Raghavendar, our own member, young member. Welcome you, Raghavendar, for this wonderful CPE seminar. And also I welcome Sarath Narayanan, Relationship Manager, SBI. Welcome you, sir. And also I welcome Mr. Arun, Forex Officer, SBI branch. Welcome you, sir. And also I welcome members for this CPE meeting. Thank you.
Thank you, Chairman. Without wasting our time, I will straight away introduce our today's speaker, CA Raghavendar. CA S. Raghavendar completed schooling in Intelligence Tirupur, did his articleship under CA Subramanian, Chennai, completed his CA in November 2019 batch, currently practicing in Tirupur. He is none other than our Subramanian Sas son. With these few words, I introduce our today's speaker, CA Raghavendar, to this August audience, and I request our speaker to start the session and proceed. Thank you.
Thank you, sir. Thank you, Mahesh, sir, for the introduction. So, am I audible, sir? Yes, thank you. Sir, good evening to all. On the outset, I thank during the beginning of the week that I should be doing the session on Friday. Thanks for the opportunity. So I will go into the presentation. Sir, good evening. Sir, is the presentation visible? Hello.
Yes, yes, Raghavendar.
Yes, sir. Thank you, sir. So today evening, I would like to say something about the risks which are there, which any exporting or an importing unit is exposed to, and what are all the methodologies which they follow to mitigate those risks, basically. So initially, why should we know anything about an export or an import risk being an auditor? Since we auditors are not directly going to deal with any buyers, we are not going to, um, we are not actually facing the risk. But however, there are two main reasons for us to know something about the risks which are involved in an export-import transaction. The most obvious and the most risky one being we do the certifications for any kind of export transactions. Like the banks are even asking an auditor to sign the total inward remittances received, and we are giving forex unhedged certificates to the banks, and so many other certifications which we don't even understand what exactly is it all about. So in Tripur, we find clients giving mail at 10:30 in the morning and asking a certificate at 11 o'clock. So within half an hour span of time, we would not be able to study the entire thing. We should be we won't even find time to Google things and find out what kind of a certificate is that. So we are facing a lot of risk giving certifications to the clients. So I feel it is important for us to understand something about the nature of the transactions which they are going through, the risks that they are facing, and in connection with that, what kind of certifications we are giving. So only if we know something about the transactions and the risks involved, we would be able to question the client. We would be able to even ask, we will be able to even know what kind of questions to ask to the client, so that we can get the right kind of data from the client, because clients themselves do not know what data is required for an auditor to make the certifications. So only if we understand the transactions, we would be able to know what kind of questions to ask, what kind of data to collect from the clients. So this is one of the major direct risks which we as auditors face in relation to an export transaction. And second important reason being, we as auditors should be able to provide proper guidance or advice, cost reduction strategies, or say if a client, a fresh client who is experienced, who is experienced in the industry, that is, and who has found a buyer, connected with a buyer, and wants to start off an export unit. If he comes and asks as an auditor, sir, how do I go about proceed with this? What all should I take care of? Or even if he comes and presents you with a document of LC, he gives it to you and asks, sir, is it okay? Can I sign this? So we as auditors should be able to understand what are the risk factors involved, how to read about the points, what are the points to look for, and to give the client a proper advice to mitigate his risk and protect him from all the persons who are looking to defraud them. So these are two major reasons which I feel. So for us to understand the risks involved and what are the risk mitigation strategies involved, and ultimately how we go about accounting for the same, what are all the disclosure requirements, what kind of certifications we can give, how it affects the certifications and all that. So in Tirupur, I find we auditors have all kinds of we know about everything. That is, we know what a backing credit is, we know what an LC is. If a certification comes, we can understand what do you mean by an unhedged foreign currency, and all this we know as an auditors in Tirupur. But but these are all in bits and pieces, so we are not able to find the whole picture. We are not able to pinpoint. Most people, I don't know, I have most clients even are not able to pinpoint what kind of a strategy you should have for a particular kind of risk. So I have, so far as possible, have tried to combine all the list out all all the possible risks and also the corresponding strategies, and just try to explain basically about what all the strategies all about. There are lots of strategies which we cannot talk in a 2-hour or 3-hour session, something like derivatives and all that. It needs a whole session of its own. So I'm just I've just tried to list out all possible risks and the corresponding strategies. So going about it, first thing is, so what are the risks that an international trade, an exporter or an importer faces? So these are the basic kinds of risk which an exporter or an importer faces. First thing is, when we say risk in an international trade, the very first thing that we understand is the counterparty risks, is the buyer risk. No, I have sent the goods, but I am not able to receive the payment. The buyer is not responding. My working capital is blocked for 3 years, 4 years, and I'm not able to recover. I don't know what to do. This is the most, when we say risk, this is the most basic risk which we understand. And the other basic risk is the forex risk, obviously. But there are also other kinds of risks. So going about it methodically, we can say the kind of risk that we face with the parties involved, be it the suppliers or the customers, is called as counterparty risk, which is most commonly understood as risk. And even the counterparty risk is of 2 kinds: performance risk and commercial risk. We'll see about that later. Besides these 2, we also have risks like country risk, bank risk, and the next 2 is the most obvious exchange risk, is the foreign exchange risk. And the last one is the most widely prevalent but no direct solution for, risk of fraud. So we'll try to understand each one by one. So the first counterparty risk for a buyer, that is for an importer, being the buyer. Just a minute. Sir, am I audible, sir? I'm facing.
Yes, Rahul, audible.
Yes, sir. Okay, sir. Okay, so the first risk which we'll discuss about is called as performance risk, which is the risk of the buyer. That is, we being the buyer. That is, we import goods from the foreign countries. So it's called as performance risk. It's obvious for the reasons why the name is so, because it is the risk of the seller not performing his part of the contract, which is called as performance. So what is the risk which is involved? The supplier may not give the right quality goods. The supplier may not give the goods at the right time, or he might send some other goods. So all these are the risks involved for a buyer in India, which is called as performance risk. And there are some strategies which we will see about later, called open account settlements, guarantees, and letter of credits, so which are used to control this kind of risk. So the next is the exact opposite of it, which is called as the commercial risk. The commercial risk is the risk of a seller from the point of view of a seller. We, as an exporter in Tirupur, we send textiles to Europe, US, and everywhere, but we are not able to receive payment for the goods. This is the most widely prevalent risk in an export transaction. So there are variety of strategies. I've just listed only a few. There are much more than this. If you go under every strategy, there are a lot of variations of these strategies. So the most common strategies which are used to payments, documents for collection, export guarantees, credit reports from overseas buyers, letter of credits, and SBLCs. SBLCs is another variation of this letter of credit. We'll go about it one by one. So first we will look into the first of both put together, that is mitigate the performance risk mitigated by open account settlements and the commercial risk mitigated by advance payments. So advance payment versus open account settlements. See, this is the very first and the most logical of it's the nothing. It's a simple way, meaning I export to another country in UK. So advance payment is the seller to prevent him the buyer to prevent himself says only if I receive the goods, I'll given a payment for the same, which is called as just a minute. Yes, when the buyer has an upper hand and buyer is demanding that only after the goods are received by me, I will go and make for the payment. So first thing is the sale contract gets finalized between the buyer and the seller. Then the goods are sent from the seller to the buyer, and only after that the payment is received from the buyer to the seller. This kind of transaction called open account settlement. This happens when the buyer is more dominant in the industry, and the buyer is capable of pushing the other person to make the send the goods first. So advance payments is the exact opposite of it. Advance payment is when the seller has an upper hand and the seller demands payments on beforehand, before sending the goods to the buyer. So here in case it is the other way around. The sales contract happens first. First the payment is made from the buyer to the seller, and only then the seller proceeds to supply the goods to the buyer. So in both of these transactions, one person has an upper hand, the other person is on a weaker position. So one person's risk is completely mitigated, whereas the other person's risk stays the same. So this is so in this kind of transaction, either one of the parties are at a disadvantageous position. So is there a way out of it? So when this happened, logically the people went about and they started going into a kind of a transaction called documentary collections, or also called as DP transactions. What is documentary collection? Documentary collection is when the documents are moved through a third party, which is not directly between the seller and the buyer, but it's moved through another person. Say for example, first, as you might see in the picture, the sale contract is finalized between the importer and the exporter. Then exporter ships the goods to the importer. After that, the exporter does not give the documents directly to the importer. Only when an exporter gives the entire set of documents to the importer in his country will be able to take delivery of the goods, will be able to take possession of the goods. And usually this set of documents will also contain the document for title of goods, something called as bill of lading. So only when that document of title of goods is transferred to the buyer will get the right to use the goods the way he wants. So until the payment is received, the importer is not given the opportunity to take charge of the documents. The goods are transferred first, but the documents are held. What happens to the documents? The exporter sends these documents to a bank, to a remitting bank, with an instruction telling the remitting bank to deliver, to ask them to deliver the documents to another collecting bank in the importer's country, instructing that particular bank to deliver the documents to the buyer only when the buyer makes the payment. So before making payment, the collecting bank will not deliver the documents to the importer, without which the importer will not be able to take delivery of the goods, though it may have reached the custom stations in that particular country, and thereby he will not be able to use it. So only when a payment is made, the importer will get delivery from the collecting bank. Again, that payment will again be routed to the remitting bank, the bank of the exporter, and payment will be received by the exporter. So this is the second level of remedy to the disadvantages which we have in advance payments and open account settlements. But this all? Does this solve all the problems? No. What happens in a DP transaction? Suppose say UK, I have sent the goods to United Kingdom. Buyer has changed his mind by that time. Buyer has changed his time. Okay, buyer has changed his mind. He refuses to take delivery of the goods. He refuses to take delivery of the documents. And he says, I don't want these goods. Simply, there is no option left for the seller. There is no security left for the seller. The seller is left with only two options. Either he has to re-import those goods to his own country, or he has to find another buyer in that country itself and convince him to take delivery of the goods. So both these options prove to be very costly for the seller. So this is a very serious risk which is there in a DP transaction for a seller. So there is also a downside for the buyer going forward. If we see buyer cannot be confirmed of the quality or the specification of the goods which he has requested before taking delivery. So he has to take delivery, he has to make the payment, he has to get the documents, he has to take delivery of the goods. Only then he will be in a position to inspect the documents, inspect the goods, and find out whether the goods are of the right specifications and the quality. If he finds those goods are not proper, his only remedy would be either he has to convince the seller, he has to return the goods, or he has to take a legal course. So there is also a risk with the buyer in this kind of transaction. So this is the second stage of it. So they found a remedy for this kind of a risk, and they found and the next level of remedy which came about is called as letter of credits. So what exactly is a letter of credit? So letter of credit, by definition, it goes like this. Letter LC is a written undertaking by an issuing bank given to the seller at the request and in acceptance with the buyer's instructions to effect payments. So what kind of a transaction is this? We'll see in the next slide. Before understanding how an LC operates, first we should be clear with certain terms like issuing bank. There are four parties involved in a letter of credit. First is the buyer, seller, seller's bank, and the buyer's bank. There are also other terms, but they are also called by another names. Like seller is also called as the beneficiary. Buyer is also called as the applicant, that is the one who applies for an LC. And the buyer's bank is also called as the issuing bank because it issues the LC. And the seller's is also called as the confirming bank, which is because they confirm the LC which is received from them. So people go about this transaction because it reduces payment risk, because everything is routed through a bank. How does this LC operate? go through the just to have an understanding. We'll go through the process. First, LC can be used both in import and in an export. So how is LC work? How LC works in case of an import letter of import transaction? First step, what happens is the sales contract gets finalized between the seller and the buyer. Now the buyer approaches his bank and asks for a letter of credit. Letter of credit, the issuing bank gives a letter of credit in the name of the buyer, confirming what to say, that payment will be received. Based on this, the buyer would be able to deliver the documents. The LC would be delivered to the seller through the seller. Then seller would be, on the basis of LC, would be able to take delivery of goods and the documents, and then payment would be made. This is how an LC operates. So I think that's it. Okay. So this is how an LC in an import transaction operates. So going forward, LC in case of an export transaction, first the seller receives the goods, receives the LC here in this case is generated by the buyer in his country. He approaches his bank and he gets an LC in his name. Now the seller who is in India receives the LC, receives the goods. Then the buyer presents the documents. Sorry, the seller presents the document. Seller presents these the final documents. This is supposed to be seller. Seller presents the document to his bank.
அது வந்து மனசுக்கு இல்லீங்களே.
எதுங்க சார்? சார், ஹலோ ஹலோ சார்.
இல்லைங்க, நீங்க கண்டினியூ பண்ணுங்க.
ஓகே சார். Okay, sir. So the seller goes and submits his documents to his bank and asks the bank to send the documents to the issuing bank. So the seller's bank sends the documents to the buyer's bank, and the buyer's bank delivers the document to the buyer. So on payment, that is. So this is how the LC transaction happens in case of an export. This is called as export letter of credit. So there is also another strategy. Before going to the next slide, LC is also not foolproof because the issuing bank, for example, I'm an exporter. I am exporting from Tamil Nadu to USA. The buyer in USA will approach a bank in USA and ask for a letter of credit. Being a person in Tamil Nadu, I will not be able to be in a position to confirm the credit worthiness of that particular bank which is issuing the LC in USA. So there are cases where LC has been issued, presumably issued by banks when inquired. Such banks never existed in the first place. So LC has also that downside. Because of this, there is also a concept called as confirmed LCs. What is a confirmed LC is, being a buyer, I will not be able to be in a position to go to the buyer's country, the seller's country, and confirm the, I'm sorry, I'm an exporter. Me being the seller, I won't be able to confirm the LC issued by the bank in another country. So what I do is I go to my bank here in India, say ICICI or some other big bank which has presence all over the world. I approach that bank and I ask for a confirmed letter of credit. When I ask for a confirmed letter of credit, the bank which I know for sure in India, which I have a credit worthiness, that bank will get a confirmation from the bank in USA, and they will give me a confirmed LC. So this is one of the ways where we can protect as a seller, we can protect ourselves from LC frauds. So there is so LC is one of the ways of reducing the risk which is posed by the earlier transactions. There is the next level of strategy, something called as export guarantee. Export guarantee is given by many agencies, but mostly the biggest agency in India giving export is called as Export Credit Guarantee Corporation, which is a government-owned entity which falls under Ministry of Commerce, and they give export credit insurance. They insure the export to a in various percentages, 80%, 90%, 100%, varies. They cover all these various risks involved, like insolvency of a buyer, which is not covered by any other strategy. Failure of buyer to accept goods, failure of buyer to make payment, insolvency of opening banks, as we discussed, failure of LC banks to make the payment. All these risks are covered by an export guarantee. So export guarantees also cover something called as country risk. Country risk, as far as I know, I don't know any other strategy which covers country risk. We'll see about country risk next. So the next strategy which they use to mitigate counterparty risk is something called credit reports. Credit reports is like CRISIL or ICRA or something. There is also a credit rating agencies in various other countries which give report on the creditworthiness of a buyer if we request for them, say like Dun & Bradstreet, Mira Inform, or some examples of such agencies. So these credit reports are based on the their performances over the various previous years. That is, whether they have honored their commitment of payment or delivery of goods and everything. So based on this credit report, we will be having a better understanding about the creditworthiness of the buyer whom we are going to deal with. So this is specifically useful in case of a first-time buyer. We have found a fresh new buyer and we are negotiating with them. In that case, credit reports would be of much use. So these are some questions which we can ask about when we are a first-time exporter ourselves. So what exactly do you know about the buyer? And we need to be careful. If possible, we need to negotiate and ask for a small portion of the entire value as an advance, so that we can be confirmed about the creditworthiness of that person. And since as I mentioned earlier, get a credit report of the other party. And understand, letter of credit is not the ultimate savior. Letter of credit can be prove to be of no use in certain scenarios. Like we have to check each and every conditions in an LC also. Whereas it could also be a scenario where the LCs become unworkable, meaning there could be some condition in the LC which could require the buyer to do some act for us to claim payment from the bank. Say for example, there have been had transactions like we are exporter. I have exported goods to another country, and say Bangladesh, and the LC has been document drafted in such a way that there was a clause in an LC asking for a certificate from the buyer confirming the quality of goods for making payment, for releasing the payment to the seller. So in that case, what happened is the buyer got delivery of the goods, quoting the certificate, and he did not even give the certificate also. So seller is at a total disadvantageous position where he loses his goods, and also he is not able to get the payments from the bank. They are also using it another way, that the buyer will take delivery of the goods, he will use it, but he will give the certificate only when he is ready to make the payment. That is, he will keep on postponing giving the certificate to the seller. So the seller is at a very high risk if these kind of clauses are incorporated in an LC. So before signing an LC, we should be careful in reading out the entire draft and see if there are any such unworkable clauses which make the LCs unworkable or unworthy. So the last point is what we have discussed earlier. If we are not sure about the issuing bank, which we are not sure, we are not just unsure about the creditworthiness of the buyer, but we are also not sure about the bank which has issued the LC. In that scenario, it is best to ask for a confirmed LC from the bank in India, that is our bank. So these are some questions or areas where we can be more careful, where especially we are dealing with a buyer, a new buyer, a fresh buyer. So this is it. This is all with counterparty risk. So these are all some strategies which people use to mitigate all the risk involved with the buyer and and bank risk, which these risks, I don't know if there are any solid strategies to mitigate this risk. These risks are always there, but it is useful for us to understand, so that because there are certain things which are based on these risks. I'll tell you, country risk means, so what is a country risk first? Country risks is a combination of all the other risks like economic risk, political risk, currency blockage, expropriation, and inadequate access to hard currencies. What is all this? Economic risk is the risk of all the macroeconomic factors which are happening. Either it might be international factors, or it might be an Indian scenario, like exchange rate restrictions, import restrictions, export restrictions, changes in policies, and all that. Political risk is sudden changes in political structure. The party may change, so their way of approach towards the foreign policies might change. A sudden war in the countries, all these accounts for political risk. Currency blockage means sudden restrictions in converting the currency of the other country. Say for we being an exporter, I have exported I have to receive payments in US dollars. Suddenly there is a complete restriction on conversion to US dollars or any rare currency for that sake. So this is called as currency blockage. Expropriation is where the government acquires the property of individual private properties and put them for public use. This could also happen in the case of war or certain change in political scenarios. And inadequate access to hard currencies. Hard currency means a stable currency, that is a currency whose value is not volatile, does not shift so often, and it is a reliable currency. So when the currency is not strong, when there is unstable currency, it also accounts to countries. Say this scenario, this country risk is happening right now in Sri Lanka. So where suddenly recently, not just recently, for past 3 4 months, I guess, the Sri Lankan government has been they are not finding their forex currency reserves are have gone down very much. So what they are doing is they are uh, putting in heavy restrictions on imports so that people are not even able to find the basic necessity goods in their countries, and so these kinds of things happen. It is right now prevalent in Sri Lanka. So this is so the country, this is country risk. We can also say country risk is not dependent on the particular buyer or anything. It is the risk of dealing with a particular nation. This risk is also one of the factors when they are which is considered while charging ECGC premium. That is why we saw in an ECGC it also covers country risk and also political risk. That is because for each country, our government has fixed a different kind of ECGC premium while you're dealing with different countries. That is the reason is behind this is because of the country risk. Each country has different kinds of risk. So if we cannot charge a single premium for all when you are exporting to all kind of countries. Depending upon the country to which you are exporting, the ECGC premium charged will vary. So this is the reason why ECGC premium also covers country risk. So the next thing is bank risk. Bank risk is simply the risk that banks could become insolvent and they will be unable to honor the payment commitments. So both of these risks in my view are it's not much controllable. So there are very less strategies towards mitigating them. And going forward, the something called exchange risk. Exchange risk, which is the most widely understood when we say risk, is the exchange risk, because the lot of accounting confusions are also involved behind it. So what is exchange risk? Exchange risk refers to the risk that or losses which happens because of currency conversion, because you're dealing with a country which has a different currency than your own currency, and the exchange rate might not be the same. So this is called as exchange risk, and it is also called as currency risk. So there are three kind of exchange risks: transaction risk, translation risk, and economic risk, also called as forecast risk. What is a transaction risk? Transaction risk is what we normally understand as exchange risk, because it is the risk due to buying and selling of goods or services from another country, and there might be the amount that we receive or pay might increase or might go down. This is the transaction risk. Translation risk is when we in India, we have a concern in India, and I am having a subsidiary in another country, say China, and China has another different currency, India has another different currency. But as per Indian standards and Indian accounting, Indian taxation principles, we are supposed to combine both these concerns and prepare a balance sheet in Indian currency. So we have to translate the foreign operations, the foreign balance sheet, into Indian currency in order for us to club both these balance sheets together. This translation involves some upside and downside, because of which the profit may go up or down. This is called as translation risk. Third is economic risk, because it happens because of any dealing which is which has unavoidable exposure to any foreign transactions, which cannot be controlled much. So these are the basic three types of foreign forex risk. So what are the strategies used to control these forex risks? So the first strategy is the strategies through banking channels. The strategies through banking channels can be pre-shipment and post-shipment. First, we'll see something about pre-shipment. Pre-shipment is also, I think we Tirupur people are much aware of this. Pre-shipment is also called as packing credit. The banks, so first, as an exporter, I have an exposure in foreign currency. Exposure meaning I have a receivable in foreign currency. So there is a risk that when I receive the foreign currency at a later point of time, the exchange rate might not be the same. So I might receive lesser goods, lesser amount. And before receiving the amount, there is a certain time gap involved. And in between this time gap, I need some money to process my, to run my business as a working capital, short term. I need some money to run my business. So the loan which is given from the date of purchase order till the date of shipment, that is till the date of bill of lading, till the date shipment is gone, till the title of goods is transferred, is called as pre-shipment credits. Pre-shipment credit, there is the most prevalent is the packing credit. Loans granted to exporters for financing the purchasing, processing, getting the raw materials, and do the production is called as pre-shipment finance or packing credit. So who is eligible to get a pre-shipment credit? Any person who has a confirmed export order or who has obtained an irrevocable LC. Revocable LC is not possible because there are RBI restrictions for revocable LC. LCs are always irrevocable. So anyway, LCs or based on export orders, a person can approach to get packing credit. The security which is generally involved is the raw material which we purchase for production. The quantum could be up to the cost of production, what kind of cost involved based on that, or based on the FOB value of the export. As far as margin is concerned, there is no fixed norms for any particular margin. It varies from bank to bank. Pre-shipment credit is usually given for around 180 days. It might change depending upon the production cycle of what kind of export you do. So this is with packing credit. Now, packing credit can be obtained in foreign currency or in Indian currency. So these both are called as PCFC and PCINR. So what is the difference between these two? So PCFC is when you obtain a packing credit in the foreign currency itself, say US dollar or euro. INR is I get a packing credit in Indian rupees. Both these strategies are different. Both these strategies are supposed to be used in different scenarios. First, we'll see what are the differences between these two. The interest rates for packing credit foreign currency, that is PCFC, is clubbed with LIBOR. LIBOR, it might be, it would be LIBOR, the total interest rate could be range from 1.1% to 3%. And the benchmark interest rate for fixing interest in case of PCINR is MCLR or the repo rate. And the interest rate could be range from 6% to 9%. What is a LIBOR? A LIBOR is a London Interbank Offered Rate. It's a benchmark rate which is fixed by the Bank of England and based on various calculations. So based on this, this is the most commonly used benchmark interest rate for transactions between banks in case of international trade. So in relation to this, there is a latest amendment that the LIBOR is planned to be abolished by the end of 2021, and it would be replaced by some other rate, something called secured overnight financial rate, or it could be it could change to some other rate also. Some other benchmark would be set, and the LIBOR is going to be repealed within 2021 end, and it is planning to be completely changed by 2023. It will be gradually phased out and it will change. So if you there is also a guidance note on derivative transactions, which we'll talk about later. Recently, the guidance note, ICAI guidance note on derivative transactions was revised in July 2021. And there was an appendix called Appendix 3, which is inserted in the guidance note, which talks about the accounting for the transition from LIBOR to another benchmark interest rate. So these are some latest development relating to interest rate, LIBOR. So what is an MCLR? MCLR is marginal cost of funds based lending rate, which is fixed by the RBI, which is the minimum rate below which the banks are not supposed to lend. The repo rate, which you might be aware of, is the rate which an RBI lends to the other commercial banks. So PCINR is linked with MCLR or the repo rate, and PCFC is linked with LIBOR. So the next thing, as far as government schemes are concerned, when you obtain a packing credit in foreign currency, there is no beneficial scheme as such. But PCINR has a beneficial scheme of 5% interest subvention, 5% or 3% in certain scenarios. This 5% interest subvention was recently extended till 30th September. Earlier it was extended till June. Then it was further again extended till 30th September 2021. As of now, it is alive till 30th September. That is by this month end. So because of this government scheme, because of this 5% interest subvention, the net rate which is charged for a PCINR goes down to say 1% to 4% when compared to PCFC, making it almost similar. But there are also other differences when you between PCFC and PCINR, like the foreign conversion, since operates like this. PCFC is obtained directly in dollars. It's a loan in dollars. So the conversion happens at the time of withdrawal of the loan itself. For example, I import. I'm sorry. I have planned to export some goods, and I go. When I withdraw that particular loan, at that time itself, the conversion happens. $1,000 into the current rate, and it is converted into rupees, and I use that for my business purpose. Whereas in case of PCINR, it is the opposite. Since my loan is in INR, I have to convert the same only at the time of repaying the loan, because I have a loan in INR of say 10 lakhs. I receive the payment from my buyer in dollars. So I have to repay the loan, which is in rupees. So only at the time of repayment of loan, I convert those dollars into rupees and I use them for repayment. Whereas in PCFC, the loan itself is in foreign currency. So as and when I take it for dispersal, I have to convert it into Indian rupees and I have to take it for my usage. So the conversion timing, there is a time difference between conversion between PCFC and PCINR. And conversion cost is obviously involved. However, as I said, there is a time difference. But anyway, the conversion cost is incurred both in PCFC and in PCINR. What about foreign risk, forex risk? PCFC does not contain a forex risk. See, look at the transaction. Since the PCFC is itself in dollars, PCFC itself in dollars. So when I have a loan in dollars, I withdraw the same for my usage, I convert it into rupees, and I use it for my production. When I receive money from the exporter in foreign currency, I need not convert the same to repay the loan. I have a foreign currency in my hand. So I use directly, I repay the loan in foreign currency itself. So there is no conversion risk involved at all in PCFC. Whereas in PCINR, I have to, since the loan is in rupees, when I receive payment from the exporter, I have only dollars. So when I have to repay the loan, obviously I have to convert it into rupees, and there is a time gap involved. So there is a forex risk involved in case of PCINR. So this is basically the differences between PCFC and PCINR. Depending upon the business requirements, the way the business structure, you can interchange between both to get the best of both, to minimize the total interest cost. As far as long as the 5% interest subvention is available, PCINR seems to be a much better option. Whereas after this interest subvention, people mostly would be shifting to PCFC. So this is with pre-shipment credit. Going forward, what are the types of strategies which are available in case of post-shipment? Post-shipment finance options. This post-shipment happens, as I said earlier, after the bill of lading is generated. That is, after the title of goods has gone to the buyer, till the time the amount is received from the buyer. In between this period, I do not have cash. I do not have enough funds to run my business. So I require a loan. So when I go to the bank and I ask for a loan, the loan which they give, the short-term loan which they provide in between this time gap is called as post-shipment finance. And post-shipment finance can be in various forms. Now, this is just an sample which I have listed out. There are furthermore methods available, like export bill purchase negotiated or discounted, export bills negotiated, advance against export bills, sent on collection, consignment, or advance against balance, undrawn balance exports, etc. There is also advance against claims of duty drawback. So these are very many ways based on the documents which I have received based on my claim eligibilities, which I can use for as a security, and I can get a loan from the bank. So the next is there are some common points which are there for both post-shipment and pre-shipment put together. So there is a clarification from RBI which many people are confused about, is that say I have exported to two parties. I have exported to party A of $60,000, and I have also exported to party B of $40,000. I have exported to party A first, but he has not made payment so far. But party B, though I have made the delivery at a later point, he has made payment of 40,000. Now, can I set off this 40,000? Yes, it is possible. So any forex receipt from one customer can be used to set off a loan receipt against another customer. So this is one clarification. And the pre-shipment credit which we have received, for example, I have received a pre-shipment credit stating that for the next 3 months will be my purchase production cycle. I require funds for production. I have obtained some funds and I am using it for the next 3 months. Suppose the shipment is not expected to be completed by the end of 3 months, it might get delayed to say 4 months or 5 months or so. So in that scenario, shipment the when the amount of exchange is not received by the due date, the interest cost involved is somewhat heavy. So as an exporter, one should be aware to keep track of all the export obligations, and he should plan it in such a way that he is able to inform the bank in advance so that the bank can extend the pre-shipment advance. So if we had not done that, the penalty cost is much higher. So this one should be careful of. And as a rule, the credit cycle, that is both the pre-shipment and post-shipment put together, cannot exceed 270 days. But in case of project expos, it can go beyond 270 days. But as a general principle, it cannot go extend beyond 270 days. So as seen earlier, it can be available both in foreign currency and in INR. So these are some common points, just to key points to note in case of pre-shipment and post-shipment. So that's all with the pre-shipment and post-shipment finance. The next financing, banking finance benefit which is given, which we have, particularly for importers, is buyer's credit. What is a buyer credit? Say I have imported a machinery, sewing machinery, and I have to make payments in another 2 months. Now, my LC, that is the LC, matures in 2 months. So when I find it that I am not able to make the payment in 2 months, so I can approach the bank and ask for a buyer's credit. So buyer's credit, based on buyer's credit, the buyer can extend his credit period to another 3 or 6 months, or somewhere between 90 days to, it could even be longer. It varies on different factors. So beyond LC due date, based on buyer's credit, an importer is able to get additional credit period. So this is basically called as buyer's credit. Earlier, buyer's credit was given against LUT, but now it is shifted to, it is given based on standby letter of credits. It is a different form of a letter of credit. So likely cost for buyer credit could be around 1.5% to 2%. And the payment period for any buyer of credit, for buyer's credit, for a normal good, it could be 1 year, non-capital goods, that is, and for capital goods, it can also extend up to 3 years. So these are some points relating to buyer's credit, and this is particularly useful only for importers. So some case study points or some planning strategies in case of exchange risk. So the first scenario is a company has 4 crore exports and 1 crore local sales. The funding is done by way of, for export, it is supported by way of PCFC at LIBOR plus 2.5%, and the business local sales is funded through CC at 10%. Now, is there any better way to do this? Now, since the person has an export, his exports are heavy, so it can also go for an option of getting PC INR. As PC INR, along with the interest subsidy, the interest can come down to almost to 1% to 4%, whereas in case of CC, it is 10%. So the interest rates are much lesser, and so you can go in for an option of both PCFC and having a PCINR also. The second scenario is a company having 80 crore of euro exports and 120 crore of USD exports. That is, he has 2 exports in 2 different currencies. Now, as a rule, only MSME people, MSME exporters are eligible for interest subvention. Beyond MSME, the other people are not eligible for interest subvention in general, but there are specific listed out categories for which interest subvention is also available. It's a huge list. So this person, since he is not an MSME, he will not be eligible for a 5% interest subvention. And so he has gone for PCFC at LIBOR plus 2% in US dollars. Is there any other alternative way to do it? Here, since he has export in 2 different currencies, it would be better for that person to split the packing credit. That is, he can go for a packing credit loan in US dollar for his relation to his US exports, and a packing credit in euro for his euro exports. Since the LIBOR rates between 2 different currencies are always different, so you can make use of that benefit. We can use it as that benefit. The interest rates would be much lesser when comparatively. So another option, another case is whether interest subsidy is applicable for service exports. As per RBI rules, yes, it is eligible. Service exporters are which I have heard that they are not. Sometimes it is we have to push the banks to make it happen. So next is a company having imports of 60 crores and fund through CC at 9%. So importers, is there any cost optimizing solution? Instead of having a CC, can he have something else? So here he can go for an option of buyer credit since he is an exporter. And buyer credit, the cost of buyer credit would be around somewhere around 3.5%, the interest cost. He can also go for a hedging to protect his forex risk. Along with it, the total interest cost would itself come around only 8%, which is much lesser as compared to the CC interest. So this is another way we can reduce the interest cost. So going forward, next is, so that's it with the buyer's credit, PCs. Now, the most very less understood, I would say, more kind of difficult to understand area, something called hedging. Hedging is a strategy. What is hedging? Hedging is a method of protecting your business against changes in currency with tools like forwards, options, etc. Not just forwards and options. There are many tools like forwards, options, futures, swaps. I don't know. There may be something new also coming up. So, why should we go into hedging? Hedging reduces the volatility in the cash flows, and it helps to have a stable cash flow so that we can plan our business ahead. So it helps in long-term finance planning also. So preparing, so we have to plan hedging well in advance, and preferably we should go for a hedge for a longer period than for a shorter period. So that would be much safer. And is there any difference between hedging and speculation? Yes, hedging is done when I have an exposure in a foreign currency. That is, I have a receivable in foreign currency, I have a payable in foreign currency. So there is a forex risk which is there in my books. In order to protect myself from the volatility, I go about and book a forward contract, or I go for an option or a future. This is called hedging. Speculation is when I do not have an underlying I have not done the export, an export of say 3 crores in the next 3 months. Right now, even before my exports are gone, even before I have made my deliveries, I hedge for the foreign currency exposure. So when I do not have an underlying exposure and when I do hedging, it's called a speculation. Because he might not be able to honor the commitments. Yeah, he might do that is, if I book a forward contract now, and if I don't receive money for the next 2 months, 3 months, because I have not done the export itself, so in that case, I will not be able to honor commitments. And this kind of transaction is called speculation. People try to make profit out of these speculative transactions, and there are various ways in which banks try to restrict such kind of transactions by placing many control checks. There is something called natural hedge, which natural hedging is when we have exposures in such a way that we do not have to plan hedging individually. We have a natural hedging. This one way it happens is when we have exports and imports in equal amounts in same currencies. I export from one particular country in US dollars, and I import from one particular country in US dollars, and I export to another country in US dollars, and almost my imports and my exports match. So this way, when I receive from my exporter a foreign currency, I can hold it as it is. I may not even convert it into rupees, and I can use it to pay the import liabilities. So in this scenario, there is no risk at all, but I have not done anything to protect my forexes. It naturally happens. So this kind of scenario is called as natural hedge. It also happens in the case of PCFCs. PCFCs, in a way, is one form of natural hedges. So this is with hedging. There are we will go into the various methods of hedging briefly. So first method of hedging is called forward contracts. Then we have future contracts. Then we have options. So, okay, now what is forward contract? For example, I have made an import of $30,000 today, and my supplier has given me credit of say 3 months. After 3 months, I know that I have to make a payment of $30,000 to him. Have it as a basic scenario. What happens since after 3 months, I'll not know how much is the exchange rate between US dollar and rupee. So I go to a bank and I go into and I ask for something called as a forward contract. Forward contracts are nothing, simply there is a contract between me and the bank telling that I agree to purchase 30,000 US dollars for a particular rate. Say for example, today the US dollar rate is exchange rate is 72. After 3 months, it might go to 75, it might go to 76, it might go to 80, 85, anything. So I go to a bank and I agree with the bank that I will purchase 30,000 US dollars after 3 months at 73 rupees. This is called as a forward contract. It's nothing but an agreement to buy or sell an underlying asset. It could be US dollars, it could be anything, at a particular price on a specified date in the future. So what are the features of forward contracts? So basic feature of a forward contract is that it cannot be cancelled. It has to be honored anyway. It cannot be cancelled. The forward contract is more of a customized contract between the buyer, between ourselves and the bank. It is between us both. We have a separate contract for it. It is done through banks. Why we say it is done through banks is because basically there are 4 hedging strategies: forwards, options, futures, and swaps. Forwards and swaps are called as OTC transaction, over-the-counter transactions. These are done through banks, whereas options and futures are called as are done through exchange or done through exchanges like stock exchanges, commodity exchanges, etc. So this is so that's why we say forward contract is done through banks. It is one of the unique features of a forward contract. And hedging could be for a period ranging from 1 week to 12 months, and um, can be utilized before maturity also, but it has to be utilized. It cannot be cancelled. It is booked for a particular day, say 3 months. It can be used. Say I can go ahead and purchase the $30,000 and I can close the forward contract at the end of 2 months also. But I cannot cancel the contract and say I will not purchase. You have to purchase it anyway. This is a forward contract. So the next thing is okay, we'll see some. I think it would be better. We'll come to this slide at a later point. First, we'll compare it with future contracts. So, what is a future contract? This is the next thing. Future contract is an agreement to buy or sell a particular commodity at a predetermined price at a specified time in the future. It seems similar to a forward contract. When you read the definition, it is almost similar. But there are some minor differences between a forward contract and a future contract. A future contract is a standardized contract. That is, it is not a contract which is customized between the person and the bank. It is a standard contract. It is in standard lots. You can buy futures only in standard lots, and the dates are fixed. Happens every month or every week or so. So it is a more of a standard contract. It can be purchased by anybody. That's why it is done through security exchanges rather than banks. And because of this inflexibility, the transaction cost is lower compared to a forward contract. And also, this future contracts can be cancelled. It need not be utilized. Whereas a forward contract has to be honored and on the due date. Whether you are on the due date, on or before the due date, we cannot cancel the same. What about options? Options is probably the most safest form of mitigating an exchange risk, most comfortable form. But as comfort also comes with a cost, so it is more costlier. How does an option operate? See, in a forward contract, we'll take the same example. We have I have purchased 30,000. I have purchased something for $30,000, and I have to make a payment of $30,000 down 3 months. So in case of forward contract, I agree with the bank to go ahead and purchase the dollar for a particular fixed rate, say 73 rupees. Whereas in options, I go and I approach. It is done through exchanges. So I go ahead and contract saying that I will purchase an how to say an option to buy dollar at 73 rupees per dollar after 3 months. It is an option to purchase. It need not be say honored on the date of the transaction. Because of this option, because of this flexibility, the transaction cost is comparatively higher for an option. It need not just be the US dollars. US dollar is just an example. Options can happen with any kind of goods. An option is now, if you read the meaning, say an option contract offers the buyer the opportunity to buy or sell depending on the type of contract they hold, the underlying asset. That is an option to purchase any particular or sell any particular underlying asset. That underlying asset could be US dollar or something. Say for convenience sake, we will take it as US dollars. I go ahead and I go for an option to purchase US dollar at a particular rate at a later point. I need not honor that commitment. What benefit do I have because of that? Say for example, today the exchange rate is 72 rupees. 3 months down the line, the exchange rate on that particular date is still 72 rupees. But I have an option to purchase the contract, the dollar at 73 rupees. So as a prudent investor, as a logical person, I will not go ahead and purchase a dollar at 73 from a particular person when I have the option of purchasing it in the open market at 72 rupees, which is much more cheaper for me. So I can go ahead, drop the option contract. I can go to the local open market, the exchanges, and purchase the dollar at 72 rupees. This benefit of whether to exercise or not, this option to exercise or not, I have under options contract. This is the major key feature of an options contract. So that's the point to note. Gives the flexibility to use hedged rate or the live rate, whichever is higher. So options can be both the ways. It can be an option to purchase a particular asset, or it can be an option to sell a particular asset. An option to purchase a particular asset is called call option. An option to sell a particular asset is called as a put option. So options is a huge area in itself. There are variety of strategies when we go ahead and when we go into F&O market, futures and options, variety of ways, but it also requires a lot of understanding, lot of knowledge, and lot of planning to go about and do an F&O on a safe manner. But it's very beneficial. But at the same time, it is also quite difficult to do it on a safe way. So and transaction cost is also higher. So this is with options contracts. So this is with these are the three broad varieties of hedging called futures, options, and forwards. And there are also other varieties called like swaps, etc. Now in forward contract, we'll see some way in which a forward contract operates, what kind of regulations are there in a forward contract. So based on the mode of operation, forward contracts also called can be operate in two ways, called contracted exposure and anticipated exposure. Contracted exposure means a person, it is also there is a legal RBI regulations based on this. As a person, I cannot go and simply go and enter into a forward contract. I need to have a proper what to say, an underlying contract, underlying exposure, export or import exposure for me to go ahead and book a forward contract. I cannot simply directly go and book a forward contract without me having any kind of exposure with any person. So the amount and tenor, there is a legal restriction, RBI restriction, that the term and the amount of the hedging using a forward contract cannot exceed the amount of the contract by itself. And getting a forward contract is very document intensive. And but under contracted exposure, that is a contract exists based on which I do a hedging using a forward contract. Under contracted exposure, the profit or loss is transferred on the due date itself. As the due date, on the due date, whatever the exchange variation or whatever profit or loss that I get, it gets immediately credited to my account. Anticipated exposure is a benefit which is given to very few people based on the amount, based on their credit history, how much exports they have done in the past, how much, what are their payment, how far they have kept up their promise of making payments, of making shipments, and all this, based on which some people are given the benefit of doing an anticipated exposure, which is they don't have an exposure as of now, but they might have an exposure in the immediate future. So based on that, they can go for a hedge. This is called as anticipated exposure. And there is an RBI restriction of relaxation, in fact, to about $10 million of anticipated exposure. Until an exposure of about 10 million US dollars, you can go for an anticipated exposure, and whatever profit or loss that you make will be credited to your account immediately. Whereas beyond 10 million, loss will be borne by you immediately, but say for example, I go for a forward contract. I'm an importer. I have imported goods for 20,000 US dollars. So I want to hedge the same. I get to purchase the same. So I go for an anticipated exposure. What happens is, say I go for a forward contract of say 3 months at a particular rate, say 78 rupees. I say after 3 months, I will purchase dollar at 78 rupees. After 2 months down the line, I make a sale. And how to put it? I make a profit because of the exchange rate on that particular date. But I have imported it, but I have not made the payment so far. On that particular date of sales, on when the date I make the sales, the exchange rate is say 74 rupees. Whereas when if I had made the payment on that particular date, I would have made a profit of 4 rupees per dollar. But this 4 rupees will not immediately be credited to my account because I do not make payment on that date. What will the bank do is the bank will keep that $4 with itself. It will keep it on hold. After say 6 months or 7 months, when I finally settle the payment, at that point, this 4 rupees will be credited to my account. This is how it operates. This is the relaxation of 10 million. Below the 10 million, the entire profit or loss will be passed on to other accounts. Beyond 10 million, this restriction will apply. This is how forward contracts operate and some RBI regulations regarding that. So this is all with the hedging strategies. So there is another way of mitigating exchange risk is by opening of something called as EFC account, Exchange Earners Foreign Currency Account. This facility allows the exporters to hold the currency in dollars itself in a bank account. And as you can understand, we need to have separate accounts for each kind of currency. One EFC for say euro dollars, one for US dollars, one for GBP, and everything. So I can hold the currency in dollars itself. I need not convert the same in rupees. So, and I can use that balance to pay off my currency exposures, payable exposures. Say I have an import of 1 lakh US dollars and I have an export of 2 lakh US dollars. I have collect the dollars and I hold it in my EFC account, and I can use that dollar itself directly to make the payment to my importer, that is my supplier. So this is another way by which we can save the foreign currency risk. So RBI guidelines allows to hold balance in EFC from 29 to 59 days. So for SCZ, there is no restriction on the number of months for which we can hold the US dollars. Transaction cost is avoided, obviously. And it is a way of natural hedging, as we had discussed earlier. So no need to convert currency. We can use this same funds to pay off the import payments. And it can be lien mark also. So for future import payments, lien mark means that we mark a particular fund, telling this particular fund will be used only for this particular import payments, something like that. So this is also acts as a method of natural hedging. So this is another way of managing the exchange risk. So these are some I believe we have covered almost all the risks and all kinds of strategies. There are still a lot of other further strategies, new kinds of strategies which are there. So this is with the strategies so far. Now, so going forward, it's 7 o'clock. Sir, how long can I continue, sir? Sir, Murugesan, sir?
Raghavendar, you can continue to 7:30.
7:30. Okay, sir. Thank you. So, okay. Now, so this is all with the various methods of mitigating all the risks of involved in an international trade. Now we will come into a very particular area of how to go about and account for a foreign currency fluctuation, because as it is the only area of all the strategies which involves accounting. The rest all areas of strategies are either documental or procedural, like say for example commercial strategies or performance strategies. All that is between it is more documental or just procedural. There is no accounting implication of the same. Only forex risks involve accounting implications and our audit implications. So accounting for forex fluctuation, where we can divide it into two ways. First, for those entities for which Ind AS is applicable. Ind AS is for very huge entities, corporates, more than 250 crore turnover and all high level entities. There are 4 Ind ASs which are as of now available. Ind AS 32, 107, 109 and Ind AS 21. 21 is on par with AS 11 which we have for non-corporates. So this is quite a broad area. I'm not I'm not what to say. I'm not touching upon these areas as of now. So what about for non-corporates? So as you might be aware of, there was an ICA guidance note, ICA note which came on 31st March 2021, I believe, 2021, revising the applicability criteria of accounting standards for MSMEs. So this is the revised criteria. What government did is they brought the applicability criteria of accounting standards for MSMEs in line with the classification for MSME, which was again altered from in 2020. So they brought almost in line with the same. Basically, simply put, MSME accounting standards are applicable broadly for any concern which is less than 250 turnover. That will be classified as level 2, 3, 4. If they have more than 250 turnover, they will it will be classified as level 1 entity, and every accounting standard will be applicable to them without any kind of exemptions. Whereas for level 2, 3 and 4, as you might see the criteria in the table below, turnover should be between 50 lakhs, 50 lakhs, I guess. This 50 crores, sorry, 50 crores to 50 crores. And borrowing should also be between 10 crores to 50 crores. It is covered under level 2. Below that, 10 to 50 band and borrowings is between 2 to 10 band is covered in level 3. And those entities which are having a turnover below 2 crore and borrowings up to 2 crore are called level 4 entities. Level 4 is a newly introduced criteria in this MSME classification, because earlier there was only level 3 levels. Now 4 levels have been introduced, and for each level the applicability of accounting standard, the exemptions for disclosure have been revamped. So this in line with this, AS 11 is applicable to all MSMEs with some exemptions as far as disclosures is concerned. Some disclosures are required, some disclosures are not required. So basically for as far as foreign exchange fluctuation is concerned, there are only two set of documents which are relevant for us. One is AS11, which talks to some extent about forward contracts and derivative part, and a particular portion of forward contract is covered in a guidance note on ICA for guidance note on accounting for derivative contracts. This accounting for derivative guidance note on accounting for derivative contracts was recently revised in July 2021 to incorporate the changes to give guidance about an appendix 3 is inserted there, which talks about the transition plan because of withdrawal of LIBOR rates. And there are various examples in those guidance, in that guidance note, which give a which explain about that accounting for derivative contracts. And there is also a format in the form of an appendix, which is for disclosure of derivatives and forward contracts. So I'll not be going much into the disclosure part. Now we'll just basically look into two examples about how to account for a forward contract, which is most widely used, and along with a derivative. So accounting for forward contracts and derivatives is widely, it can be classified into three ways. First is hedging transactions. How to account for a hedging transaction. Speculation, how to account for a speculative transaction, and derivatives. Within hedging, it's not there in the picture, but within hedging, there is a kind of hedging called as hedging for firm commitments, which requires a different kind of accounting treatment. We'll come to that. So, so basically, a transaction, first classify the transaction into three buckets: hedging, speculation, and derivative. Hedging, within hedging, there are two ways: either hedging for firm commitments or hedging done in a normal exposure transaction. This the other than firm commitments hedging part and the speculation part, these two are dealt with in AS11, whereas the hedging for firm commitments and accounting for derivatives is dealt with in ICA guidance note on derivative contracts. How is the accounting explained? So first thing is, so the first accounting is forward contract book. I'll just explain the points and we'll see an example where we'll be able to understand it better. So first method of accounting is applicable for a regular forward contracts. A regular forward contract, AS11 is applicable. Whatever is the premium of forward contract, that is, premium is nothing but the forward difference between the forward rate and the current exchange rate. That difference should be amortized with, during the period of the forward contract. And whatever is the balance, it should be held in books, take it to P&L. Simple direct accounting. It involves some journal entries. When we see the journal entries, we'll be able to understand it better. Speculation is much more simpler. Any speculative transaction, don't go dig into what is the forward premium, what is it loss, anything, everything. Just account the value difference between the rate and the actual rate and the rate at which it is closed. That entire difference is accounted and taken to P&L. It is a plain M2M transaction, mark-to-market transaction. This is with speculation. We'll see an example with speculation also. Third part is derivatives. Derivatives and also a particular type of transaction called forward contract for firm commitments. Now, what is a firm commitment? Firm commitment means um, uh, I do not have an underlying exposure today. As on the day when I book a forward contract, I don't have a I don't have an exposure. I book a forward contract based on a presumption that at a future date some exposure might come up. This is called as firm commitments. So, for example, if I have a sales today, I have made a sales today for say 20,000 US dollars, and I wish to account and I wish to hedge that $20,000. If I go for a hedging, it is called as hedge of a regular transaction. It is covered under AS 11. Whereas I don't have a sales today, but I have a contract. I don't have not even a contract today. I believe that I will be able to get into a sales contract after 1 month. So I hedge 20,000 US dollars today itself. This transaction is called as forward contract in case of firm commitments, and it is not covered under AS 11. It is dealt with under ICA guidance note. This, along with other derivative products, everything is dealt with under ICA guidance note. What is accounting under ICA guidance note? Under ICA guidance note, value, which is not, that's the fair value to P&L. Charge it to P&L, either profit or loss, just charge it to P&L. This is plain simple accounting. But this causes volatility in the P&L. The P&L becomes very, can go up and down anytime. So if hedge accounting, the ICA guidance note gives an option to do something called hedge accounting. But to use this hedge accounting, there are certain conditions to be met. Only if those conditions are satisfied, we can go for this particular type of accounting. What is this accounting? This accounting is say I book a forward contract. I have not made sales so far. So in between the date between a booking of forward contract and the date in which I make the sales, that difference of in exchange rate is not charged to P&L initially. It is charged to a separate account called as cash flow CFH transaction. Cash flow hedge is called as cash flow hedge, and it's called it is transferred and kept it in a reserve called as cash flow hedge reserve. And at the point when I make the sales, that CFH transaction converts itself to a transaction called fair value hedge. Or when it becomes a fair value hedge, the entire amount which is there in the reserves is charged to P&L either as a profit or a loss. This is how we go about with accounting for derivatives and forward contract in case of firm commitments, these two types. So basically there are three types of so we'll just see one example in case of firm commitments. Yes. Sir, is it visible, sir?
Yes, sir, I will.
Yes, sir.
Very
visible, sir. Okay. So this illustration is an example of the first kind of transaction, which is a forward contract for in a normal scenario. So, so on 1st January 2005, a company entered into a foreign currency transaction by taking a loan of $1 lakh. The amount of loan is required to be paid by 30th June 2005, 6 months later. On 1st January 2005 itself, the company entered into a forward exchange contract for the transaction to mitigate the risk associated with changes in exchange rates. And the exchange rates are given rupees as per US dollar as below. Spot rate on 1st January is 45, 31st March is 47, 36 is 52. Forward rate for 6 months is 48 and forward rate for 3 months is minus 51. Assuming the accounting year is the financial year, journal entries are as below. So first, what happens on 1st January? The first part is I entered into a foreign currency by taking a loan of 1 lakh US dollars. So first journal entry I will book as bank account 45 to foreign currency loan 45. 45 is the spot rate as on 1st January. So foreign currency, this is the first entry which I would pass. And on the same day, I go and book a forward contract. So for forward contract, I pass a journal like this. I go for forward contractors, my forward contract rate is 48. So the premium which I have to charge to P&L is 48 minus 45, which is 3 rupees. So I hold it something called deferred premium account debit. Since I cannot charge it entirely to P&L in the first shot itself, I need to split it and then I have to charge it on a time proportionate basis. So deferred premium account debit rupees 3, foreign currency receivable rupees 45 to amount payable to bank rupees 48. This is just a forward contract entry. The amount does not go, it's just a contract entry. Foreign currency receivable shows up in the asset side. Deferred premium also, as of now, it shows up in the asset side. Now, what happens on the balance sheet date? In between the balance sheet date comes. So what balance sheet date comes after 3 months? I am in January 1 now. Balance sheet happens on 31st March. What I do on 31st March, I charge the deferred premium, portion of the deferred premium for 3 months into P&L. Premium account, which is expense account, I amortize that for 3 months. That is at 3 rupees divided by into 3 by 6. So 1.5, I charge it to P&L. Second entry which I do is I book a forward foreign exchange loss on the loan part. The loan payable has which I have booked is 45 rupees. But as on 31st March, my rate is 47. So I have an additional 2 rupees to pay. So I book loss for that particular 2 rupees. Foreign exchange loss account to foreign currency loan rupees 2. Third entry is I have also have an account of receivable account and foreign currency receivable. Since I have done the hedging, I have 45 rupees receivable. But since I have to account for the exchange difference. So the exchange rate as on 31st March is 47. So I have 2 rupees profit in that regard. So I book profit to that extent. Foreign currency receivable rupees 2 to foreign currency exchange gain rupees 2. So what happens as a result of these two entries is because of hedging, this is the effect of hedging on P&L. The P&L, the profit, the loss which would have not been hedged, now it gets set off. The entire loss is set off from the it is gone from the P&L. It does not exist anymore. What exists is only the premium which I have paid and which is amortized on a time proportionate basis. This is what happens during what to say on 31st March. After 31st March, the next 3 months, what the balance of premium is charged to P&L, and whatever is the exchange difference is booked, profit or loss, net profit or loss is booked, and the amount is settled. These are just regular entries, which I don't want to go deep into that. So this hedge account, as you may see, will have a nil effect on the P&L, which otherwise would have a big debit on the side because of foreign exchange loss. It might also be the other way around. Okay. So this is how we count. This is the first type of accounting which I was talking about, which is forward contract under AS11, regular forward contracts book. What about second type of accounting? Forward exchange contract entered into for trading or speculation purpose. It is much more simpler. Say in the using the same illustration, we can see on 1st January, if it had been a speculative transaction, there is no underlying exposure, meaning the first entry will not happen because there is no loan at all. I just book a foreign currency receivable to amount payable by bank of 40 rupees because I only go for a hedging. I only go for a forward contract. There is actually no loan. So first entry would be directly foreign currency receivable to payable. As on 31st March, I would charge the difference in rate entirely to P&L of 51 minus 48 is entirely charged to P&L or booked as an exchange gain in this case. Similarly, again on 36/2005, when I close the transaction, again I book an exchange gain. The difference between 52 and what the rate as on 31st March, the difference of 1 rupee, I book it as profit. So this is the second type of transaction, direct simple transaction. This is the transaction which which is not covered under AS11. That is forward exchange contract entered into to hedge the foreign currency risk of firm commitments or highly probable forecast transactions. This is the firm commitments which I was talking about. It's a very huge example which I have. Hello, sir. Hello, sir, Ramu, sir.
Rahul.
Sir, I think that's it, sir. I don't have that example. Should I give an example also for that? The third accounting type.
Okay.
Just a minute.
If you have it, you can give it Raghavendar, or otherwise you can just explain it.
Okay. The example which I have is quite complicated, sir. I don't think I can explain it. But the basic understanding is this. The third type, that is under ICA guidance note, there are two options. Either you can charge the exchange rate difference entirely to P&L as a profit or as a loss. Second way is by using something called hedge accounting. But for using a hedge accounting, there are certain conditions to be fulfilled, like documentation and some certain things. Only after fulfillment, you can go for a hedge accounting. If you go for a hedge accounting, the difference between the rate from the date of booking the forward contract till the date of actual sale invoice being raised, that difference is will be called as cash flow hedge, and it will not be charged to P&L. It will first be kept in a reserve called as cash flow hedge reserve, CFHR, separately in balance sheet. When the sale entry is booked, the CFH, that is the cash flow hedge, will convert to something called fair value hedge. On that date, whatever is there in the reserve, that is in cash flow hedge reserve, will be charged to P&L, and rest all is a regular transaction entry. This is about the third entry. Probably I will share a document which has a very huge example about this transaction along with bad debt entries. That would be much more. You can understand it better when you go through that, I guess. So this is all that I wanted to say. So that's it. This is all with international trade risk, and accounting part is it's actually very small because the detailed most of the transactions are dealt with under Ind AS. The Ind AS part is very huge. There are 4 AS covering variety of transactions, but which is mostly not applicable for any MSME. For our MSME sake, these are the only 3 types of accounting as far as hedging risk accounting is concerned. That's it. I think thanks to everybody. Thanks for the opportunity. Sir, good evening.
Yes.
Ramu sir.
Ramu sir is, I think, is not available.
Okay, okay, sir.
Okay.
I think
Okay.
that's it, sir. Anything?
Okay,
Anything else, sir?
Thank you for your wonderful presentation. Now I request our members, if there is any query or any doubts, you can directly ask the speaker or you can put it in the chat box also. Query session. Murugesh, our sir, Sarath Narayanan sir.
Sarath Narayan sir பேசுவீங்க.
Sir, Sarath Narayanan sir. Good evening, sir. I think some noise is there, sir. Some noise, sir. Some blurry noise. Yeah. We are not able to clearly hear you.
Still, the issue is there.
Now it's okay.
Okay, keep the. First of all, thank you. I actually sat through this whole session. A lot of interesting things. I mean, especially regarding that forex hedging and all I know, but accounting aspects and all, yes, it was really nice. I mean, I also learned a lot of things. Let me be very honest, I was very reluctant to join this session because all of you chartered accountants are highly qualified people, and I am not like that. I am a banker and I deal mostly in forex and trustee. So that is, I mean, in that there is yes, there is an element of risk involved, but it is not as I mean, we don't go into as much depth as this. We mainly observe markets on a regular basis, and based on that, we take our calls. So I wish, I mean, so in this aspect, I think if any of you have any specific queries, please ask me, sir. Otherwise, I am from my side, there is nothing.
Nothing. Okay, sir. Mahesh?
Yes, sir.
Arun sir?
Arun sir is not in there. It's not joined.
Join பண்ணிருந்தாரு.
பண்ணிருந்தாரு, but left I think. Arun sir is not there, sir. Okay, members can ask the speaker and our chief guest, our today's special guest is Sharath Narayanan sir. Is there is any query? You can directly ask both.
Please ask yourself one.
Yes. You can put it in the chat box also, or you can directly ask the speaker or today's special guest, Sharath Narayanan.
Anybody have a doubt? Please ask yourself.
I think Raghavendar explained it beautifully.
I don't know whether I have done justice, but
You've done more than justice.
I just to put. I just wanted to try to put everything together in a logical way, which is to make remembrance also easy of various strategies involved. I don't know how far I have done it, and I don't know whether there are any mistakes since this is the first time. So, any seniors, if they have any comments or if I have made any mistakes, especially in accounting part and things, please let me know so that I can correct also.
You done very well, Rahul. No, 2 hours.
Sir, one more request, sir. Actually, if it is possible, can you share this presentation? Because especially
sure, sir.
Yes, sir. Yes, sir.
Sure, sir. I'll share the
for
presentation.
derivative transactions, I need to study more.
Yes, sir. I'll share the document. I have a separate guidance note and all some examples and things. I have a detailed example for forward contract accounting with every possible entries.
Yes,
I'll
sir.
share all the documents, sir.
Sure, sir. Thank you, sir. Thank you very much, sir.
I think no one has any doubt. Yes. Muresh, no? Shall we?
Conclude பண்ணிடலாங்க மகேஷ்.
Thank you all. And very special thanks to CA Raghavendar, who made great effort to prepare this detailed presentation. Actually, it was a very wonderful presentation and very detailed presentation. You made great efforts actually, and I once again thank you very much. And you put a lot of effort, I think, to prepare for this, and the preparation has paid off. Actually, you did a wonderful job actually, and I thank you once again. And I thank today's chief guest, A. Sharad Narayan sir, for accepting our invitation readily.
I am not CA, sir.
Sure,
No,
sure, sir.
No problem, sir. Go on.
No problem. Sharad Narayan sir, for accepting our invitation and actually participating throughout the session. Actually, from
Yes,
the
yes.
initial to the end, yeah, through the session, and for making additional points. I also thank Mr. Arun, who is also joined in the beginning, and due to some preoccupied commitments, I left the meeting. And I once again thank our today's participants who participated in this event, in the CPE seminar. And I also thank branch members who made these arrangements for today's session. I thank one and all again, and thank you, Shri Raghavendar, once again.
Thank you, Raghav.
Thank you for the branch for giving this opportunity, and especially Murugesan sir and Ramu sir. Thanks a lot, sir.
Thank you, Sharath. Yeah. Thank you, Sharath Narayan sir. Thank you for.
Thank you, sir.
Thank you.